Want to pay off your mortgage? This isn't for the irresponsible, and I'm not going to pander the advice to ignore economics due to some bad behavior. Look, don't pay an extra cent to your mortgage until you listen to this, and don't make these mortgage mistakes I'm about to unveil. You got to beware of putting your family and your cash at risk when trying to pay off your mortgage. We're going to discuss biweekly payments. Are they the miracle they're supposed to be? What about refinancing your home and when it should be done and not done? When does it make sense to roll equity to a new property? Or how much of a down payment should you make? Is it a good idea to shorten loans? Is it a good idea to have a bunch of money tied up in your home in something called equity jail? Is there stress? Is that stress worth paying it off, right? And does it make sense to pay this off before investing in yourself or other things that are out there? And I got a question. Why is it when people pay off their mortgage, do they become less coachable? Thinking that they've just made it. They've arrived. Oh, I've paid off the mortgage. Now my investments are exploding. Well, if your investments were doing so well, why wouldn't you do those before? And there's really a lot of liability on the equity of a paid off home. So whether you want to pay it off or not pay it off, these are the things to know first. But before I get there, got to talk about the ream. I tell you, my kids, they're absolutely genius at making me think that they're stupid. And they're not at all. I mean, they understand all the latest technology. They can pass the most complex video games in no time. They can even crack my 17-digit Apple ID password like professional code breakers. I think they have their ear to the door. Is that a ampersand? I don't even know they knew what an ampersand was, you know? But when it comes to helping around the house, they can somehow convince me they have no idea what I'm talking about and can't do or understand anything. Hey, kids, sweep the porch. They're like, what's a sweep? I mean, like when you hold a broom and walk forward, they're acting all confused, just letting the broom fall out of their hands. Dad, what's the Wi-Fi code on this? Wait, how's this even work? Doesn't even have a power button. You don't have a power button. Is that why you don't work? So I end up showing them how to sweep like an idiot, knowing full well everybody knows how sweeping works. I get done and they're like, great job, Dad. You're just so good at that. We'd hate to take it away from you. Stupid geniuses. Like, they know how to use DoorDash, but they don't understand that I'm paying for it. I had to tell them the only reason the app works is because I do. It isn't some magic button that just summons food. It requires money to work. My money. Plus, those a-holes never even order me anything. Look, I try to be a good father. I'm always thinking about my legacy, so I don't want to just give my kids money and spoil them. My kids are actually really smart. My youngest is a curious kid. In fact, the other day he asked me, Dad, how do banks make money? I was like, oh man, I'm in finance. I'm going to crush this. So I said, well, son, they rent your money by offering you a tiny bit of interest, and then they sell it to other people by charging them a much higher interest rate to use it. He's like, Dad, what's a tiny bit of interest? Well, it's what your mother has every time I tell a joke. He says, Dad, but what if they lose the money? Well, son, don't worry. There's the FDIC to insure the money. Insurance company? Well, no, it's the banks putting money into an account that insures us. So they just pay us back with our money? Yeah. So that's why the bank gives you a lollipop, sucker? Dum-dum? I wasn't sure if I wanted to kick him out of the car or add him to my financial team. Look, you always hear that it takes money to make money. Oh, but it's never the bank's money. No, it takes your money for them to make money. Anyone that tells you it takes money to make money or you have to spend money to make money is just trying to separate you from your money. It's like the chicken and the egg scenario. Which came first and who bought dinner? Sorry, bad joke. It takes money to make money. Then how did people get the first dollars? Like, who paid for the first money printing press? Were they just like, hey, if you guys build this thing, we'll print off the first couple of sheets for you? Oh, wow. Thanks, the bank. These guys could have just kept the machine. But then the Fed made it so only they can determine how much money can be printed and only the banks can hand it out, and good luck trying to get any money back from the bank. All right, let's dive into the biggest mistakes people make when they're trying to actually pay off their mortgage. The first one is biweekly payments. See, you've got monthly payments. That's 12 payments in a year. If you pay every 2 weeks, well, that means that you're making 26 payments for the year, which in essence is supposed to be like half of what a monthly payment is. But because there's not just 28 days in a month, it's like making an extra full payment for the year. So let's look at a $300,000 mortgage at a 5% annual interest rate over 30 years, okay? So monthly payments for 30 years. If you do biweekly payments, you're going to pay it off in about 26 years. So it's going to shave about 4 years from the mortgage term. But you got to realize that's because there's an extra payment from the biweekly schedule. They effectively result in one extra monthly payment per year, right? So that extra contribution accelerates the principal repayment and reduces interest paid over time. It's not magic. It's a full extra payment. I saw this Instagram video where this guy's like, I just pay every other week and I make the same payments, but my house pays off in like 5 less years. No, you jackass. You paid an extra payment. Good. Great. If you want to pay it off sooner, it will help you do that, but there might be more effective ways, like saving the money in a side account, maximizing your tax deductions along the way, saving up that money and earning interest on it, then paying off that mortgage in the future in 26 years instead of just having the money tied up in your mortgage. So yeah, it will pay it off sooner, assuming there's nothing else better that you could have done with your money. Second issue here. There's a lot of people that just refinance or they move. I mean, I've moved 3 times and, we stayed in our first house for 9 years, our second house for 9 years. We've been in this one for about 4 years. But there's a lot of people that move or interest rates change. We've recently saw an interest rate drop, so people might want to refinance, and that has additional expenses. So every time someone refinances, most of the time they don't just go, okay, well, I have 26 years left. I'll refinance to 26 years. They refinance to 30 years, adding 4 more years to the loan and having fees. So what do those fees look like? Application fee of $200 to $500. That's charged by the lender to process your application. Loan origination fee is usually 0.5% or 1% of the whole loan amount. That's the lender's administrative cost. There's appraisal fees, $300 to $750, depending on the size of the home, right? Title search and insurance, $700 to $1,200. Got to make sure you have a clear title and protects against disputes. Credit report fee, $30 to $50. Recording fee, $100 to $300 from a local government for recording the new mortgages. Escrow fees and closing costs, $400 to $1,000. The payment to the escrow company for handling funds. You might even create prepayment penalties, and it varies. Like there's a soft prepayment, which says if you move and sell, that's fine, but you can't refinance. If you do, there's going to be additional fees. So these are some of the things that you kind of need to take into consideration. There might be discount points. There might be, prepaid interest to lower your mortgage rate. These are all things that when you're refinancing can have an impact. So take that into consideration even if the interest rate drops and then measure that. The third issue when people are trying to pay off their home is they don't value their money and they just go, I'm going to make a huge down payment. Now, how much money do you save in that down payment versus using that money to pay off higher interest rate credit cards or student loans or investing in cash flow assets that actually help you to build more cash flow or tax advantaged assets? You got to consider the opportunity cost. The fourth issue here is a lot of people are encouraged to shorten loans. If you shorten your loans, you fix yourself with a higher payment. That higher payment, if you have a cash flow crunch, creates risk. Those forced payments give you less flexibility. The fifth issue here is just not understanding the cost of money. You always pay interest. If you pay cash, you forfeit the right to earn interest. If you borrow, you pay someone interest. So you have to ask, if I'm going to give you money and I don't charge you interest, how much do you want? As much as possible, right? How fast do you want to pay me back? As slow as possible. So you can do better than 0%. Now, if they're giving you that loan for 1%, you could do better than 1%. But if they're giving it to you for 20%, you're like, hell no, I want to pay that off as soon as possible. The sixth issue when trying to pay off a mortgage is people get stuck in equity jail. They double down on paying extra, and then all of a sudden there's more equity in the home, but they can't access that without a line of credit, and they have to apply to get that line of credit, and they can get that line of credit taken away. The other issue is just trying to pay this off can create stress and pressure. Putting off life, not enjoying it along the way. That takes me to the eighth issue, which is pretty much the same thing. Less to invest in yourself. Make more money. Invest in yourself. Increase your skill sets. Learn how to keep more of the money you make by becoming efficient and building your financial team. Then learn how to create cash flow and be a cash flow investor. And then consider whether or not you want to start paying off this mortgage. And it might make more sense to pay off the mortgage than try to invest in things that are uncertain, that might not have as high of an interest rate on a guaranteed level of what you're paying on a mortgage. It depends on your investor DNA and what kind of investor you are. Here's my bigger issue with this. I just don't understand why when people pay off their home, they're done learning. They've learned everything there is to know about finance. Yet they could probably save a boatload on tax, choose the right corporations. They could invest better than just in the stock market and in 401ks. But they think somehow, because they paid off their home, they've made it. Now, this isn't everyone. It's just like the people that follow Dave Ramsey for some reason. They become overly judgmental, and they think that if you don't do what they did, then you're an idiot. And I hate that type of thinking. It depends on who you are and what your preferences are. The 10th issue here is if you pay it off and you're not in a homestead state like Florida or Texas, your equity is subject to lawsuit and liability. So you got to take those things into consideration. All right, let me recap this. Biweekly payments, yes, you can pay off the home sooner, but you're making extra payments. What else could you do with that money? Be careful on refinancing and just lengthening the loan, because if you're really trying to pay it off, that might not be helping. If you're just rolling equity every time you can get a bigger home because you've been paying on the existing one for a while, you're starting over. A big down payment might help you to have a smaller payment, but not as good as having that money become cash flow or having liquidity so you're not having to borrow on credit cards. If you shorten your loans, you're into a fixed payment. If you have equity in a home, it's equity jail, because the only way to get to it is by borrowing it or selling the home. If you get so stressed paying this off that you're not doing other things that help you enjoy life, or it's draining your energy, you are your greatest asset. And if you're not taking care of yourself, I don't care if you have this mortgage paid off or you're getting close. If it's draining you, you have less to produce. If you're not investing in yourself, that could be costing you long term. And if somehow paying it off makes you less coachable, well, don't be a jerk. Continue to learn. And then finally, there's liability on equity. So my issue in this world of mortgages, and in this world of just telling everyone that they should always have a mortgage or never have a mortgage, it doesn't allow for personal finance to be personal. Look, I have a good friend, Rich. When he went to be an entrepreneur, his wife's like, can we just pay off the mortgage? And he's like, but it's such a low interest rate. He's like, I'll feel better. Great. He did, and it made her feel better, and he sold 19 companies. If my wife was saying, I just want to have a mortgage paid off and make me feel better, it might not be our best economic decision, but we're a couple. I'd be okay with that because I want safety and stability for my family. You've got to understand your significant other's preferences and also yours, and find the best situation for both of you. Don't go to the lowest common denominator and just say it's always one way or the other. And another issue is, don't consider your home this great asset. How's it going to create cash flow for you? Now, if you utilize and leverage the Rockefeller method, you can have a permanent death benefit that you could use as collateral to access equity in the future without putting your home at risk. It's a reverse mortgage that you could do that with and pay it off with the death benefit when you die. So there maybe are some ways to do it, but far too often, this is a much greater expense than an asset. It could appreciate in value, but it's not actually adding to your bottom line along the way. And there's just plenty of institutions marketing what's best for them, not for you. Hey, we'll charge you less interest if you do a 15-year mortgage. Well, that's a higher payment. They want their money back quickly, and they know most people move or refinance, so they're in the game of cash flow. Why would they charge you less interest for something that's supposedly in your best interest? They're charging you less interest because it's in their best interest. There's less risk for them the more equity your home has. So be careful not to become arrogant and think you have it all figured out just because you pay this off, or judge others for not doing what they think, is best. Don't feel like you've arrived and that you've got it all handled. Keep a beginner's mind. We're always learning. But also, let's not become simpletons and only look at this one-dimensionally and say, oh, I'm saving interest, and not understand the economic view, that there's opportunity cost and what can you do with that money otherwise. And don't allow, whether it's me or anyone else, don't let judgment come from the gurus. What is your preference? What do you want? What is your peace of mind? What matters to you? Let's go to the what would money Jesus do? Look, the sooner you get better with money, the easier life will be. But one thing to be aware of is when you have money, you tend to pay other people to do things rather than learning to do it yourself. For example, personally, money hasn't made me a better handyman because now I can afford to hire one. That's nowhere as impressive to my wife, right? It's just nowhere near as impressive. It's not like I don't try to impress her. I do. I actually put up a shelf the other day. It was level, held stuff. She was impressed. Till it fell down a few hours later. What can I say? Look like Jesus. No good at carpentry. All right. So what's the solution? Never mortgage if you can't afford the 15-year payment. If you can afford a 15-year payment and do a 30-year mortgage, save the difference between the 15 and 30-year payment. I love using the Rockefeller method. My preference is, cash value of whole life insurance because it's available. It's tax advantaged. Once the dividend is paid, it's guaranteed. It's protected from lawsuit and liability. Other people might have other locations, but that's something that I like. And, if you want to learn more about that, What Would the Rockefellers Do talks about that with the Rockefeller method. wwrd@garrettbgunderson.com on Instagram, and I'll hook you up. All right, I'll just give you a copy of the PDF. Don't prepay or make extra payments directly. Get your 6 months liquidity minimum first. And then measure and say, if I pay extra, how much do I stand to save and when do I save that versus if I use that money somewhere else that's relatively safe and accessible. Now, don't go refinance a home and invest it all in the stock market. People did this. In 2006, I remember people just getting lines of credit. Their homes were appreciating. They weren't doing anything about it. It was just the way the market worked. And then they'd take that and they'd go invest it in the stock market. Until 2008, the stock market crashed, the real estate market crashed, and now they had a loan that they owed on an asset that lost a ton of value. So don't risk and speculate this, right? If you're going to pay it off, consider paying it off all at once. Look at the method to get there that's safe, efficient, and effective, and that can help your objective of paying it off. Don't put more than 20% down unless you have the majority of the money to pay off the loan, and then consider a home equity line of credit. That could be a first position. So let's say you have $1 million property and you're going to put $900,000 down. A home equity line of credit can allow you to take your money and pay down that line of credit, and it'll lower your payment as time goes on and only pay the interest. And then you could also, use more of it if you run into some cash flow crunches. The key here, though, is to live below your means until you're economically independent. Don't overextend yourself with some major mortgage that you can't afford. Continue to use the Wealth Accelerator framework. Make more money. Invest in yourself, your skill sets, how do you add more value, how to serve more people, how do you solve bigger problems. Keep more of what you make. Don't overpay on tax or on interest. Find where there's non-performing fees in your investments and eliminate those. Protect your downside. Learn due diligence. And then the fourth, find out where you have duplicate coverages or improper structure with your insurances. Raise deductibles. Get umbrella policies. Find ways to transfer catastrophic risk, and you cover the minor stuff, and you'll keep a lot more of your money. Right? So number one is make more money. Number two is keep more of the money you make. Then the third is grow your money. Learn your investor DNA. Investor DNA? Well, I write about it here in Killing Secret Cows too. There's actually an awesome workbook that helps you figure out what your investor DNA is that comes with this as a bonus. And then finally, grow yourself. Grow yourself, because if you grow your money without growing yourself, there's a risk in that gap. If you don't enjoy your life along the way, you could still probably be miserable in the future. Find a way to design the life that you love. Create the life you don't want to retire from. That's the key. Mastering your finances is certainly going to be helpful, but master your life and you can find fulfillment.